Hi guys, welcome back. I'm really excited to have you here. This is going to be the ICT Forex Mastery lesson on the ICT strategy. Before we start with the ICT strategy specifically, I really want to remind you that what we have seen so far still applies. We have talked about so many different and super important concepts, such as, for example, the psychology and the emotions. We have touched upon how to check for the news and how to set your agenda. We have looked at different trading times and at time in general as a very important ICT concept. We have looked at the process and we have talked about candlesticks, but also about the basics of trading. We have seen what is liquidity and how to spot it on your charts, and also how to spot with your naked eyes fair value gaps. Recently, we have talked about the power of three and about bias. And so, guys, everything that we have still seen so far applies. Things such as interest rate differentials, commitment of traders, the monthly and the weekly narrative and bias are still important, but we will just put them on a side for the sake of this video because I really want us to focus on strategy. What's strategy? Well, a strategy is simply a plan of action that's designed to achieve a long-term aim. And so, with a plan of action designed to achieve a long-term aim, what we're talking about is taking things one step at a time, checking if we see what we are looking for, and so seeing if the price wants to behave in a certain way. We're talking about waiting and actually preparing to act. We're not just talking about action, but about waiting and preparing to act. And we always have a long term goal in mind. Guys, so far you've done a great job in this mastery, and I'm really proud of all of you. I know that you are able to follow a simple step by step process that's repetitive, that's simple, that's easy. That is actually and very hopefully going to be super boring for you very soon. I just want to remind you a couple of things. This is a process. It's repetitive and it takes time to master it properly. The different steps are not to be taken as interchangeable. They are set in a specific way and you do them one after the other. What you can customize though are the time frames. And so I know traders that prefer to trade on higher time frames. I know traders that prefer to trade on the 1 minute time frame, and that works perfectly for them. This is something specifically that you are gonna have to figure out for your own in the next weeks. But remember, that depends also on your character, on how you work, on what works best for you. I want to tell you this, guys. Considering that the ICT strategy is a process, I want you to remember that when we are observing the charts and we are not able, for whatever reason, to find and see any of these steps, and so if we get to step number 7, for example, and step number 8 is missing and we cannot see it out there, do not enter any trades. This is something that many traders are having issues with because they think, okay, I've seen 10 of the 13 steps, now it's my time to enter, it's gonna be okay, yeah, sure, I'm missing this one. They kind of ignore it. I don't want you to ignore it. I want you to become super, super picky with all of these steps and to enter a trade only when you see all of these steps happening in front of you. And so, if you don't see a step, walk away, knowing that you have preserved your capital. Guys, being able to not enter a trade, to walk away during your trading times is still one of the most important decisions, and definitely the first one that you need to take when you sit down in front of the charts. So you sit down in front of the charts and you tell yourself, if I don't see what I want to see from the price behavior and the price movements, I'm willing to walk away. This is the ultimate freedom, the freedom to not enter a trade. And now, guys, let's go. Let's start talking about the ICT strategy and let's do it step by step. I'm really excited. I'm going to first and foremost present you the different steps and then we're going to see a series of examples. Step number 1, find your daily bias. Step number 2, look at the chart at the right time of the day. Step number 3, observe your chart on the 1 hour time frame first. Step number 4, find the liquidity levels and the fair value gaps. Step number 5, observe the chart on the 15 minutes time frame and find liquidity levels and fair value gaps. Step number 6, at the right time, wait for the price to take out a previous liquidity level. Step number 7, when that happens, go on the 5-minute time frame. Step number 8, wait for the price to reverse. If the price took out a high, for example, wait for the price to go lower. If it took a low, wait for the price to go higher. So we're waiting to see the price reversing. Step number 9. In that same movement, after the price has reversed, we're looking for the price to take out a previous level, so a previous high or a previous low. Specifically, if the price is now going lower, we are going to look at the price taking out a previous low. If the price is now going higher, we're going to be taking out and looking for the price to take out the previous high. Step number 10. In that same movement, we are looking for the price to create now a new fair value gap. Step number 11. In that same movement, we are looking for the price to show a big displacement. Step number 12. Now, when the price creates this fair value gap, stop and check. Is it according to our bias? Is the price behaving according to our bias? What are the reasons why the price would want to go in the opposite direction of what we are expecting? I don't want you guys to just blindly enter a trade and enter a fair value gap when you see this confirmation until point number 11. I really want you here to stop a moment, play the devil's advocate, and try to convince yourself to not enter a trade. This is a very important step because we're not trading mechanically, we're not bots. And so we actually need to be really convinced that what we are doing is correct. That doesn't mean that we are never going to enter a trade when it is not going according to our bias. For example, maybe our bias was that the price is going to go higher, but it's already the afternoon session in New York and we're trading from 2 to 3 in the afternoon. And the price already did what we were expecting. Should we not enter a trade then? No, we should of course enter a trade, but we should have always very clear in mind the reasons why the price could be doing something different. And we need to be okay with that. We need to be okay in accepting that certain amount of risk. Step number 13. We want to enter a trade when the price taps back into the fair value gap. To do that, we can go on lower time frames if you haven't already. Step number 14, we're going to enter a position while the price is inside the fair value gap and we are going to set our take profit and our stop loss. Now guys, that you have all the different steps, let me give you an example. And so let's take a chart. Let's take a chart of Euro USD on the 1-day time frame and let's observe the price movements. Well, what are our steps? Our step number 1 is to actually find our bias, our daily bias. And so here we already see that charted we have specific levels. We have the closing level of the previous candle and we have the current closing level in orange of yesterday's candle. Considering that this candle did not close over the high of the previous one, that means that we are in a range, and by being in a range, we do not know yet what the price wants to be doing next. And so our daily bias in this case is not set. Number 2, let's look at the chart at the right time of the day. And so in this case, we take the 1 hour time frame, and so we observe our chart on the 1 hour time frame first. Here we find liquidity levels and fair value gaps, and you can see them here charted. Then we're going to observe the chart on the 15 minutes time frame and find liquidity levels and fair value gaps. And here I wanted to show you the whole range of movements. You can see here that the price took already out the previous level of buy-side liquidity from the previous day. Here you can see the chart's movements on the 15 minutes time frame a little bit more zoomed in so that you can really observe the different fair value gaps and liquidity levels. Number 6. At the right time, wait for the price to take out a previous liquidity level. We can see here that the price actually already did that because we had a previous liquidity buy side level that was formed around 9 a.m. in the morning, and the price just went higher and took it out. It's totally okay, guys, if this happens before we sit down to be trading, as long as those are good levels of buy side liquidity or sell side liquidity. Step number 7. When that happens, we're gonna go on the 5 minutes time frame. Notice here, guys, it's not yet 10 a.m. New York local time, and I'm already sitting in front of the charts, charting and trying to understand what the price wants to be doing next. And so here we are on the 5 minutes time frame, trying to understand better the price movements. Step number 8. We're going to wait for the price to reverse, meaning if the price took out a high, which it did in our case, we are waiting and looking for the price to go lower. I know many traders see the price taking out the buy side liquidity level, and then instead of waiting for the price to reverse, they believe that the price should continue in the same direction, and then if it forms fair value gaps, they try to take them. This is not how we trade according to this strategy. It's very important that after the price has taken the buy side liquidity level, in this case, and it has formed a new high, that we wait for the price to reverse. And so in our case, to wait for the price to go lower. Step number 9. In that same movement of the price going, in our case, lower, we're looking for the price to take out a previous level. And so if the price now is going lower, we're going to wait for the price to take out the previous low, which you can see here with a red dotted line. Now, guys, if you have not already, this would be a good moment to actually go on a lower time frame. Remember, you need to check out for your character, for your personality, which time frame works best. I know traders that prefer to go on lower time frames much earlier because for them it makes sense and they are really quick in taking decisions and they're really confident. I myself, for example, prefer to stay and spend a little bit more time on the 5 and on the 3 minutes time frames. Step number 10. In that same movement, we are looking for the price to create now a new fair value gap. And we have it here. So in that same price movement, the price is still going lower. We're waiting for the price and looking for the price to create a fair value gap. And you have it here with a red box. Step number 11. In that same movement, we are looking for the price to show a big displacement. And this is how ICT frames it. I want to tell you actually what we're looking for. We're looking for the price to be actually moving away from that liquidity level. We don't want it to stay close by. We don't want it to stay in a range. We want to see, if possible, bigger displacements, bigger price movements. And if not, we still want it to see far away from that liquidity. Step number 12. When the price creates this fair value gap, we're going to stop and check with ourselves. Is the price going according to our bias? And mainly, what are other reasons why the price would want to actually go into the opposite direction of what we are expecting? So we're expecting the price to go lower, a little bit lower, and to take a previous low, right? And so we want to have here reasons why the price should be doing something different. That doesn't mean that we are not going to be trading. It simply means that we want to be extra sure that when we enter a trade, we are doing the right thing. And now, if we are ready and if we are convinced, step number 13. We want to enter a trade when the price taps back into that fair value gap. And here we see it happening. The price went lower and then it actually came back higher and tapped into that fair value gap. This is a good moment to enter our trade. We're going to set our stop loss and our take profit. And now, actually, what we are seeing and observing on the 5 minutes time frame is that this trade specifically, if it goes according to what I believe it's going to go, and so the price is going to go lower and reaching into that fair value gap, it should be a 1.54 risk to reward ratio trade. Usually I go for trades that are around 2, 2.5 minimum, and this respects my rules and my strategy. And so I'm gonna go for it. This is how that same trade is looking like on the 3 minutes time frame. You can see here a little bit better that on the 3 minutes time frame we have different fair value gaps, and the fair value gap is a little bit bigger on the 3 minutes time frame. And so when we set our stop loss, for example, it's good habit to respect price level on lower time frames. Now, how did this trade actually go? Well, here you have a screenshot of how the price moved for that specific trade. The price first and foremost went a little bit higher, still respecting the fair value gap on the 3 minutes time frame, but going a little bit higher than the fair value gap on the 5 minutes time frame that we can see here in red. And so if I would have put my stop loss exactly on the line of the fair value gap on the 5 minutes time frame, it's very likely that it would be taken out. Instead, in this case, I did not. I went with the 3 minutes time frame and everything worked well. Remember always to check for yourself and keep in mind your risk appetite. When I enter a trade, I want to follow all the steps and I want to be 100% sure. Here we put our take profit at the next low, which in this case was the low of the same price movements. We have put our take profit on the level of the previous low inside that fair value gap. And as you can see, I entered my trade around 10:45, and in 1 hour my trade hit take profit. I want to show it to you also on the 5 minutes time frame. This is how it looked like, and on the 15 minutes time frame. Now guys, let's see together another example, always going step by step from a different day. And so let's look at Euro USD on the 1 day time frame. Here we are talking about the 18th and 19th of February 2024. So first we need to find our daily bias. And here we can see that the price went actually higher, a little bit higher than the previous day high, but it closed lower than the previous day high. And so we are not sure again what is our bias in this case. Step number 2, we're going to look at the chart at the right time of the day, which in our case is going to be before 10 a.m. New York local time. Now we have here all the remarks on the 1 hour time frame because we always sign them up first on the 1 hour time frame. And we can have here our buy side liquidity, sell side liquidity, and our fair value gap that formed the day before. So finding our liquidity levels and our fair value gap levels, it's a check. Number 5, we're going to observe the chart on the 15 minutes time frame and find liquidity levels and fair value gaps. And in this case, you can see the 15 minutes chart and a different liquidity level. Number 6, at the right time, we're going to wait for the price to take out a previous liquidity level. And so we can see that the price took out the previous liquidity level around 8 in the morning, and then it kept going lower, formed another liquidity level, and now it's just taking it out yet again. Number 7, when that happens, we are going to go on the 5 minutes time frame and keep observing the price movements. Number 8, we're going to wait for the price to reverse. And so in this case, the price took out a low and we're going to wait for the price to go higher. And we keep following the process. Number 9, in that same movement, we're looking for the price to take out a previous level. So if the price is now going higher, which it is, we're waiting for it to take out that previous high, which you can see with the dotted green line. And the price did indeed take that previous high, and it started going a little bit lower. Number 10, in that same movement, we are looking for the price to create now a new fair value gap. And so we're waiting for the fair value gap. This could also be a good time for you guys to go on a lower time frame to enter that trade. Step number 11. We can see here that the price actually has created a fair value gap. And what we want to see here is we are looking for the price to show a big displacement. And so to see if the price is actually moving energetically. And it looks like that it actually is. I'm not super excited about these price movements and about their size, but it could still be okay. Step number 12. Now, when the price creates this fair value gap, we're going to stop and check. So the price here has indeed created a fair value gap, but that fair value gap is finding himself before the price takes out that high. And so maybe this could be a good time for us guys to go on a lower time frame to see if we want to enter the trade from there. Step number 11, we're going to look if the price is actually showing us a big displacement or a displacement. And so if it's moving away from the sell side liquidity. And it looks like that the price is moving away from the sell side liquidity. And so we can check the box. I'm not super enthusiastic about these price movements, but it could still be okay. Step number 12. Now, when the price creates this fair value gap, we're going to stop and check. Is there anything wrong with what the price is doing right now? Do we like these price movements? Is there any other reason that we can see that the price could be going into the opposite direction? Play devil's advocate and let's keep on going. So this would be another good moment to go actually on a lower time frame to see if we want to enter really this trade. And so by going on a lower time frame, we're here on the 3 minutes time frame and we want to see if we want to enter the trade. Please notice guys, here we have two fair value gaps. The smaller one in blue is the fair value gap on the 5 minutes and the yellow and orange one is the fair value gap on the 3 minutes time frame. You can see that the price has created this fair value gap on the 3 minutes time frame and that is entered it already once. Step number 13, we want to enter the trade when the price taps back into this fair value gap. I've been maybe a little bit slow, I didn't go earlier on the 3 minutes time frame and so far I didn't enter any trade. But let's see if the price taps back into it yet again. Step number 14, we're going to enter the position inside the fair value gap and we're going to set our take profit and our stop loss. And so you can see here that I set up my trade when the price entered back into this 3 minutes fair value gap. And I set my take profit as the previous high and my stop loss a little bit lower than the 5 minutes fair value gap. What happened next? Well, this trade, guys, is a 2.69 risk to reward ratio trade. So it would be in line with the type of trades that I take usually. Well, we can see that this is a trade without any markups that regard the trade itself. And in just 12 minutes, the price took my take profit and it kept going higher. So we can see the trade on the 5 minutes time frame. On the 5 minutes time frame, guys, in this case, we would actually not had an entry. Did you notice that? Like the price did not go so low until that moment to touch the fair value gap on the 5 minutes time frame. And this is how this trade looked on the 15 minutes time frame. Okay, guys, let's see a third example. As usual, let's look at Euro USD on the 1-day time frame. First and foremost, we need to find our daily bias. And so you have here the different levels. This tells us that we are actually expecting the price to go lower than the dotted red line. Step number 2, we look at the chart at the right time of the day. And so here we step to the 1 hour time frame and we observe the price movements. Remember, we are expecting the price to go lower than the previous day's low and the previous day's sell side liquidity. But we do not know where the price will close and when it will take that low. Step number 4, find liquidity levels and fair value gaps. And so we here have a big fair value gap from the previous day. There was a news day and we can see our buy side liquidity and our sell side liquidity levels from the previous day. Number 5, we're going to observe the chart on the 15 minutes time frame and find liquidity and fair value gaps yet again. We're going to go to the right time and we're going to wait for the price to take out a previous liquidity level. And so here specifically we can see the 15 minutes time frame price movements and the price on the 14th of February 2024. So from midnight until now, a little bit earlier, the 3 a.m. New York local time. Step number 6. At the right time, we're going to wait for the price to take out a previous liquidity level. And we can see that happening here. Step number 7, when that happens, we're going to go on the 5 minutes time frame. And so we're going to observe here the price movements on the 5 minutes time frame. Here it is, the price went lower and took that level of sell side liquidity. So we have today's sell side liquidity and the previous day's sell side liquidity taken out as well. Number 8, we're going to wait for the price to reverse. And so in our case, the price took out a low. And so we're going to wait for the price to go higher. So in our case, price took out sell side liquidity, and we're going to be waiting for the price to go higher, and so for the price to reverse its direction. Step number 9. In that same movement, we're going to look for the price to take out a previous level. So if the price now is going higher, and it looks like it's going higher for us, we're going to wait for the price to take out the previous high. And we keep observing and waiting for the price that now it's going higher to take out the previous high. Please guys, notice that we are just waiting here, taking our time and waiting for the price to go higher. We keep waiting for the whole session. We are on step number 9 and we're waiting for the price to go higher to take out the previous high, but it is actually not happening. There is no movement here that justifies the price going higher and taking out the previous high. We can see that the price is within a range between today's sell side liquidity and the lower liquidity level that it just created by taking out yesterday's sell side liquidity. But this is not actually what we want to see. And so these price movements do not justify us going to step number 10. The price simply doesn't do what we want it to be doing, and so we cannot go to the next step. And remember, guys, we do not enter any trade when we do not see what we want to see, when we do not see the step-by-step process. We simply stop there at whatever step we currently are, and we just enjoy the price movements. We do not enter any trade. Remember, guys, the strategy is always the same. It's supposed to be boring. It's supposed to be repetitive. It's supposed to be one step at the time. And you can customize this step to your preferred time frame. You can customize when you switch time frames as well. And this is something that I believe has put in trouble some traders because they do not understand that this is a step by step that needs to be followed religiously, basically, and that you really need to stop if you do not see something that is giving you confirmations. But you can customize it to different time frames because we have seen how time frame and price interact with one another, and you need to customize it also to what works best for you, with your character, with your personality. Please guys, notice that we are going to be looking at precise trade setups later on. I want you to first and foremost familiarize yourself with the different steps, that you find the right time frames that work for your character and that you make it boring. Remember, it needs to be, and you need to make it repetitive. You need to make always the same steps, one after the other, and it has to come natural to you at one point. And so that natural, that is a little bit boring. Trading in this way should be boring, should be repetitive, it's always the same steps, and you should customize it to yourself. Make it completely your own. You're doing a great job, guys. You're doing a great job in this mastery. Remember, this is the way.